Thanks for joining us back for the BI Primer. What we're going to look at now is a real quick example of a business interruption policy and look at some of the key terms that are important to know if you're going to measure a business interruption loss. Here we have a typical business interruption policy, which is the CP0030, and this is the business income and extra expense coverage form. We run into this quite commonly. Now, there might be other forms out there. A lot of the different insurers have their own versions of this, but basically this is a very common form that we run across and is a good way to cut your teeth on business interruption. There are other forms that may not include extra expense. There are other forms that may also have differences in the way that they treat payroll. So let's look at the terms of how the policy defines business income. What you find is that it is comprised of net income that would have been earned or incurred, and the continuing normal operating expenses incurred, including payroll.
Now, net income that would have been earned or incurred could also mean you have a net loss, in which case you would take credit for the loss against the total of all the continuing expenses, but it would have to be considered as part of the calculation.
Now, these policies use the term continuing expenses, but really what you're talking about are fixed expenses. And then the alternative, or the flip side of that, would be non-continuing expenses, which would effectively be variable expenses. So a good way to look at this would be to take a look at rent. Does the business continue to pay rent during the outage period? And where do we go to look for that? We look at the lease. So if they continued to pay rent because rent does not abate per the lease, then it's a continuing expense and would be paid by the policy. But if there's a provision in the lease to say that rent does abate and they do not continue to pay it, then it's a variable expense and we take credit for it.
Now, many businesses, when they get into business interruption, cash always becomes critical. And it's important to note that you're insuring net income and your expenses. You're not insuring any sort of cash flow. So when businesses do have some of these interruptions, many times they're able to take advances, but you still have to mitigate and you still have to get back up in operations to get the cash moving as soon as you have a loss.
Now, how much of the net income and continuing expenses does the policy ultimately pay for? The policy will use the term actual loss sustained. Now, we'll look at that in another segment, but just be aware that the policy does define it, and then there is a test to determine whether something is ultimately paid on an actual loss sustained basis.
So what's the process for projecting the net income and continuing expenses? Typically what you'll end up doing is looking at the historical financial results of the business. So what we do is we'll take the historical P&Ls and some of the other financial records, and we'll make projections for what we think the business would have done had there been no physical loss or damage. Then from there, we're comparing that to what the actual financial results were, and that's how we're drilling down and trying to get to what the actual loss sustained is in accordance with the policy. So where do we go to find these terms? And it's actually defined at the bottom of the policy, and one of those terms is the period of restoration. And what you'll see is that it begins 72 hours after the time of direct physical loss or damage for business income coverage, and ends the earlier of the date when the property is described premises should be repaired, rebuilt, or replaced with reasonable speed and similar quality, or the date when business is resumed at a new permanent location. So reasonable speed and similar quality just essentially means like, kind, and quality. So we're not adding time to the period of restoration if there's cases of modifications or upgrades and things like that. But essentially, when you're looking at the period, it's tied to the physical damage. So the period begins when the physical damage occurs, plus a 72-hour waiting period in cases of business income. For extra expense, there is no 72-hour waiting period. And it's going to end when the physical damage is repaired.
Sometimes what happens, though, is that an insurer may determine that an insured has not done enough to mitigate their loss and may in turn cut off that period of restoration based on the terms of the policy. Sometimes what also may happen is that an insured may decide to move locations based on the speed at which they can get back up in operations. So in the case where a physical building was damaged,
they may move to a temporary location and resume permanent operations, in which case the period of restoration ends. Now, I'm a business owner. My physical damage was repaired and I opened my doors, but not everybody flocks back into my business as soon as I'd like. So one of the ways that the policy deals with that normal ramp up to get back up to your normal level of operations is something they call extended business income. Typically it's 30 days, it can be 60 days, 120 days, I've seen it as long as a year. But really what you're looking at is that the policy affords an additional 30 days of coverage for you to be able to ramp back up to your normal level of operations. So that's another defined term in the policy. It begins the date the property is actually repaired, rebuilt, or replaced and operations are resumed, and ends the earlier of the date you could have restored your operations to the level they were pre-loss, or 30 days after the beginning of the extended period. So to summarize this, what we're talking about is we're making a financial projection for the net income and continuing, which in many cases are just the fixed expenses of the business, for a defined period. And that period is defined loosely based on the physical damage. So as of the point where the business sustains the physical damage for essentially what becomes the repair period. And at the end of the repair period, then the policy may afford an additional 30 days or something like that in order to ramp back up to the normal level of operations.